Howdy, Jacob here. Today we're looking at Emcor Group in the construction and engineering industry. 20.8 billion, 20.9 billion in market cap, 20.0 billion enterprise value. So it looks like they have more cash on hand than debt, which is very positive. They provide construction and facility, building, and industrial services in the US and UK. They offer design, integration, installation, startup operation, and maintenance services related to power transmission, distribution, and generation systems. It looks like their growth is extraordinarily impressive, where their only year-over-year revenue decline was during COVID. Outside that, since COVID, they've been growing double-digit year-over-year revenue growth. Something that is not crazy impressive is their margins, but something I do love is their increase on growth on both gross and operating margins. Gross was about 14% 10 years ago and is now 16.6% in 2023. And operating was 4.4% in 2014 and is 7.0% in 2023. They have paid a dividend. It looks like they were on a stint where they didn't increase it for a while. And in the last 3 years, they have increased it. It is essentially nothing compared to their earnings per share. And so a very small payout. And it is just a 0.2% yield. So it is a very small payout and a very small yield. Their return on invested capital has historically been very good. And more recently is even better. Lots of signs looking up here. Balance sheet shows 790 million cash and cash equivalents, 2 million short-term debt, 3 million long-term debt, no debt essentially. So way more cash in hand, no debt. Love that from a balance sheet perspective. Absolutely amazing. From a cash flow standpoint, their capex is up, still very small and inconsequential in relation to free cash from operations, and the cash from operations is up even higher from a percentage standpoint than their capex. Their use of cash historically is very heavy on the acquisition side. They did a lot on debt reduction recently, but again, they're down to $5 million in short-term and long-term debt. So they can free that cash up to buy back shares, hopefully at a cheap price, make acquisitions that are efficient, and pay this dividend, I guess. And so for me right now, the majority of cash flow in the future is going to be going to acquisitions and share repurchases for the next 7 years, it looks like. So I'm comfortable making some assumptions. I think for revenue growth standpoint, they'll be able to make some acquisitions like they've done in the past. Their biggest acquisitions here are 2016, 2019, and most recently 2016, 2019. So when they're able to make those acquisitions, they grow really well. And in relation to their free cash flow, $200 million and $300 million dollars in aggregate for net acquisition is actually pretty reasonable compared to free cash flow. So I think that they will be able to grow pretty impressively over the next 7 years. Probably 8% a year for me seems reasonable, with margins of, these margins aren't great, but they are increasing, which I do appreciate, and I do like that. Okay, income tax, but they don't really have any interest income because they don't really have any debt. So for me, for margins, maybe let's do 4.5 and 5. I mean, that's on the definitely on the higher end, but again, it has been going up. So I do think that's reasonable. Those are reasonable assumptions. Share repurchases, 1% for them is about a little over 200 million. I think that's pretty reasonable. So just 1% share repurchases. Terminal PE on 8% growth, a bit through acquisitions, but they are being strategic with those acquisitions. But you're looking at low margins, but again, good return on invested capital. So there's some positive, there's some negatives here. I do think 16 to me makes a lot of sense. I'd maybe even go 17. So market average historically, depending on the duration that you look at, if you look at the last century, it's about 15, maybe 16. And so for me, 17 is saying that it's a little bit above market average. Maybe you'll get a little bit greater revenue growth, but it is coming more from acquisitions. Good return on invested capital, but those low margins are going to hinder your ability to really get those, really efficientize the business because their gross margin is as low as it is. The dividend, I mean, I'll increase it 8%. It's essentially nothing in relation to their It's less than 10% of their free cash flow. So I'm fine increasing it with their revenue growth. And we're saying it needs to fall 63% before we get the return I look for here. So again, it's one of those companies where almost everything I looked at outside of really the margins looks fantastic. Great balance sheet, great growth, good return on invested capital, just great free cash flow growth. But it's just not the price that makes sense to me. And I think to me, that's the most important part. To someone else, maybe it's not, but based on everything that I understand about investing, it's really just the price you pay for it. I mean, again, if we knew something was going to give me $100, $200, $400, $800 over the next 4 years, there's a price I'd pay for that. But would it be $10,000? I mean, absolutely not. But if you're going to give me $100, $90, $80, $70 over the next 4 years and you're offering me it for $100, yeah, I'm going to take it. I get my money back the next year. Everything else is just extra money. So, I mean, to me, everything's the price you pay for it. And I think this is a great company, okay margins, but one that I just don't think it's at the price that it makes sense to me. So I hope you enjoy the video and have a great day.